Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize two official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, welcome to Elite Goodnight. Today is February 18th and I'm Huang Peng Wei. We'll be discussing two topics today. First of all, congratulations to everyone and Happy New Year. It's already been more than 2 months since 2026 began, and there have actually been a lot of events. Moving forward, there will still be more changes in direction, but the biggest recent development is Kevin Wash. It's now pretty much confirmed that he could be the next chairman, and he might take office soon, ushering in a new era. Let's talk about that. What does this coming to power mean, and what impact will it have on investments? I'll talk about this by looking for clues in the earnings reports of major companies and also discuss new investment opportunities. As we can see, starting in January, many companies have begun releasing their earnings reports, and the big tech companies are no exception. So what new opportunities can we spot from their reports? First of all, let's talk about Cam Wash. From what we can see, he seems to be a pragmatic person who understands the market well. Although he hasn't made any particularly notable speeches yet, his main stance at the moment can be inferred from various channels and his past statements. Based on an analysis of his comments, it seems he believes that the large-scale application of AI should first be used to boost productivity and drive growth. So this is essentially economic growth driven by technological advancement. That's what this is about. In other words, the economy can grow on its own without the Fed needing to intervene too much. He probably thinks that in the past, the Fed relied too much on data and lacked foresight. So now he believes they need to have their own direction and take the lead in the market, but at the same time, not over-intervene in the market. We've been discussing how, obviously, the balance sheet reduction will be adjusted, and a lot of people are talking about this point. Right now, nothing has been finalized, but it's actually something that can be done. Doing it this way would help ease the pressure on businesses and households. Plus, with reverse repo operations, there's time for things to return to normal as well, right? Basically, it's about turning the structure of the MBS into something short-term, and as for mortgage-backed securities, they would return to the market, with supply and demand determining the interest rates. So these things can be done if they want to, but it really depends on how they implement it going forward. Ultimately, for these measures to succeed, it depends on whether people buy into it or not. But if everyone believes that AI can really drive inflation like this, then as for Chengdu's economic growth, even if there's balance sheet reduction and interest rate cuts, there can still be credit expansion to support the real economy. So everything I've just described is actually a pretty ideal scenario. As for the path forward, it really just takes time to verify it, and right now what we're doing is we can imagine that in the future there might be the result is something everyone can be satisfied with. Inflation isn't too high, the economy can keep growing, and overall interest rates are coming down. Then, long-term interest rates are determined by market supply and demand, so they won't go too high either. In this kind of scenario, well, this might be because right now he hasn't really said much, and as for whether Ken Wash can get Trump's nomination, if he does, he'll definitely support Trump. In the end, it's actually possible that there could be a big change like that, but it's also unlikely. Trump wouldn't nominate someone like Powell, for example, someone who's always at odds with him or doesn't see eye to eye with him. The way things have worked in the past is that no matter what, the central bank would always step in to back up the market. That could mean different types of support or measures. Actually, after 2008, this became pretty obvious. The result was that asset prices soared and the real economy became disconnected. This is basically how it's been for the past several decades. For decades now, this is the outcome we've seen. Economic growth, wealth has flowed into the hands of a small group of people with assets, making their wealth even more concentrated. So the distribution's pretty unequal right now. Going forward, maybe there will be a greater emphasis on there might be a stronger focus on providing money in a more organic way and being really cautious about things like tempos. So what does that mean? Will assets be repriced? Only companies with solid long-term fundamentals, outlook, and financial structure will have a chance to come out on top. In other words, going forward, we probably won't see a lot of companies all surging or all plunging together like before. That is to say, We won't see that kind of a rising tide lifts all boats situation anymore. There will be a clear split. The best companies will do well, while the weaker ones might not do as well, or could even drop sharply. But good and bad companies might still exist within the same industry and could even hold similar positions. It really comes down to the financial structure of each company itself when you look at the details. Some companies may have entered the market earlier or have a higher moat, which gives them more advantages. So actually, this phenomenon also matches what we're seeing right now in the US stock market, where the Dow Jones is relatively strong. I can tell you that since the beginning of this year, the Dow has performed better than both the S&P 500 and the Nasdaq. This is also in part because of this. On the one hand, tech stocks in the stock market have been rising for several years now, and recently the rally has started to broaden, with funds flowing into some lower tier company stocks. On the other hand, this also highlights the value aspect. People feel that tech stock valuations are already pretty high, so they're looking for companies that aren't as highly valued to invest in. All right, so moving forward, in the coming months, the US stock market might see some sideways movement, which is relatively high. Right now, the S&P is hovering around 7,000 points, and its price to earnings ratio is already about one standard deviation above the 5-year average. At this point, there's not much room left for broad-based gains. Going forward, it's actually going to be hard to rely on valuations anymore to further drive the market up. And since last April, we've actually seen a pretty clear rally, and there hasn't really been any major correction. So now it's basically like we've reached a certain level and are stuck here, just waiting for the next catalyst or event. That being said, from the first quarter through the first half of the year, things should still be relatively favorable, including the stock market period, because we all know that the midterm elections are in November. Right now, it looks like Trump's prospects aren't looking too good, but actually, a lot of data and timing point to Trump pulling back in various areas. And in this situation, as for employment, right now we're seeing relatively low hiring and low layoffs, so there's really not much going on. So at this point, people are saying that the Democrats could end up controlling the House of Representatives, but it's unclear whether they'll have a shot at the Senate. Looking ahead, before the election, the stock market is likely to experience more volatility. So actually, from the first quarter through the first half of the year, it should still be a relatively stable period. But this also matches what we mentioned to everyone at the end of last year, which is that the first quarter of this year would be the best time to act. What we didn't expect was that a lot of the gains this year happened so quickly in January. Now, looking at the current rally in January, it seems like things are starting to cool off and take a breather. We're looking to see if there's another chance for a rally outside of January, sometime in the first half of the year. Right now, the valuations of the S&P 500 are actually quite high, and with these elevated valuations, it's pretty tough for the market to keep climbing unless there's some new catalyst. And right now, especially with the index hovering around 7,000, this situation actually, looking ahead, it seems like individual stocks will have more room to perform. But if we're talking about the overall market moving up, it might take another 1 or 2 quarters. Okay, so he said that the S&P 500 is basically moving sideways right now, just hovering around this level. A lot of analysts are predicting it could reach 8,000 points, which would be about a 15% increase. So that kind of gain would actually, that's still pretty decent, right? Double-digit returns. But for a lot of individual stocks, there should be even more opportunities to shine here. So going forward this year, everyone might want to focus more on specific sectors and look for leading stocks with strong fundamentals and trending momentum. In a bit, we'll mention some individual stocks as examples. You don't actually need to pick that many stocks. In fact, investing is really about following a few good picks and sticking with them for the long term as they grow. That way, you can capture a significant portion of the gains. And the Dow Jones is actually doing pretty well. It's already broken through the 50,000 mark. Now we'll just have to see if the Dow can keep moving upward. Looking at it, the Dow should continue to perform relatively well. It's showing a slow upward trend. You can see that the S&P 500 is basically flat, but in terms of its pattern, it's actually slowly moving up. This reflects the current flow of funds. And it also shows changes in how people are viewing valuations. Next up is the Nasdaq, which actually hasn't performed as well as the others. The real estate market is still relatively weak, so money is likely to flow out. This phase may last for a while, so it really depends on when funds will start flowing back into tech stocks. As for the Philadelphia Semiconductor Index, it's doing well, mainly because of the ongoing semiconductor boom. This upward momentum is concentrated in just a few stocks and sectors, which we'll talk about in a moment. All right, so what are the investment trends for 2026? Actually, the trends should be pretty clear to everyone. Right now, it seems like we need to focus on tangible assets over virtual ones. Many things in the virtual world, like Bitcoin, just aren't favored. Metals, on the other hand, are in high demand, and the performance of these tangible assets is far better than digital assets. So, as you can see, metals have been performing really well this year, while Bitcoin and other cryptocurrencies haven't shown much movement. Besides the shift from virtual to tangible assets in the financial markets, the world as a whole is also gradually returning to what might be considered a more traditional path. It's kind of like the way things used to feel, right? People are putting more emphasis on industrialization now. If you look at manufacturing in the South, for example, there's less focus on things like securitization or the service industry. As for AR, actually, AI is shifting from basic infrastructure to transformation and also to electricity. The main focus now is whether you can make money with AI. If you can't make money with AI, even if you do a lot of things, people might not favor you. As for what's next, actually, software stocks are currently under a lot of pressure and facing a lot of challenges, and that's the reason why. Of course, I'm saying that software stocks might be replaced by AI. Now, take digital companies, for example. They have plenty. They've proven themselves. And maybe they can still claim they're not affected by performance, but their stock prices keep dropping, which just shows that the money isn't flowing there right now. As for energy, that's where everyone is focusing their core investments. It has a relatively defensive quality against volatility. So when everyone is building their portfolios, let's say you have an investment portfolio and want to allocate across many individual stocks, then if you want to be conservative with part of it and you want to allocate to these stocks, then you can still choose those because there's a solid demand for them and they won't disappear due to changes in the economy because you still need energy. It's basically an essential, irreplaceable thing that keeps the world running. If you want to maximize, you can still allocate a bit to these energy stocks. As for semiconductors, it's really about seizing the business opportunities in increasingly advanced and miniaturized packaging. Right now, looking at the whole sector, when it comes to semiconductors, within the sector, the holy grail stocks are still going strong, but honestly, those have already gone up a lot. If you think the equipment stocks have also risen quite a bit recently, then you can still keep an eye on Broadcom. Broadcom's one of those companies. Its software and connectivity segments both have strong advantages, and overall, it's a comprehensive beneficiary in the semiconductor space. Plus, its stock price is relatively weak at the moment. All right, so as you can see, actually around the end of February, between late January and late February, a lot of companies announced their capital expenditures, including major tech companies. Their capital spending increases were actually pretty astonishing. We're talking about 2025 already. This is ramping up. Everyone's talking about over 400 billion, but by 2026, it's expected to reach 651.1 billion. Then by 2028, it might even surpass 700 billion. The Japanese say this is something you just have to invest in. If you don't, your competitors will. Even though people think that right now Google is the obvious winner, other companies still have no choice but to get involved. Because if you don't, you'll definitely lose. But if you do, you might not lose. There's still a chance. For example, as we heard, Amazon's projections are actually pretty astonishing. This year, they're expected to spend about $200 billion in capital expenditures, mainly investing in logistics, AWS, and so on. So right now, the hot topic is that everyone wants to at least secure a spot at the table. So this all comes down to the planning and demand for capital expenditures. In the future, it will also prove that AR can actually make money, and it really can change a lot of things. But to achieve these benefits, we need to make the necessary investments. This is mainly illustrated in this book. So this is about high income, high demand, and high investment in order to maintain competitiveness. So the pressure, or rather, it's obvious that these well-known companies are the ones on the table. The big players, because they're the ones who really have to take the lead. For them, their depreciation might increase, and will their profit margins get squeezed? EPS might go down, so that's something to consider when looking at their valuations over the next few years. That's basically the situation I'm talking about. But who actually benefits from this? Well, you could say it's their suppliers. Their suppliers are the ones providing them with, for example, the GPUs they need to buy or when they need to do this kind of thing. Whether it's assembling things every month or if they want to make their own custom ASICs and need to find someone to do it, these suppliers are usually heavily involved. On the other hand, nowadays it's really about looking at your return on investment from all angles. It's not just about being an investment. If you're doing something at a high level but can't deliver the corresponding returns, or if your revenue or profit growth is actually slowing down, then people won't think you're great. They'll feel like you don't really know what you're doing. So that's the situation. For Payon, a technology company, what we focus on is that their performance in this area is really strong because this is something everyone has to do. The revenue and profits across all departments are able to keep up, and they're showing corresponding growth with pretty solid results from different perspectives. That's what everyone is looking for. The key point is that when it comes to suppliers, there are actually good ones and bad ones, because as we mentioned, it could be due to their financial systems. Companies with solid fundamentals and mature operations tend to perform better, while others won't do as well. You won't see that kind of across-the-board surge where everything goes up together. In terms of technology, even though many companies fit the theme and meet the criteria, even if a company is part of the supply chain, if its utilization rate is squeezed or it can't maintain its operations, then its revenue growth won't be sustainable and it won't perform as well. So when it comes to suppliers, it's not as simple as just finding the suppliers of these big companies and thinking you're set with a good investment target. For suppliers, you also need to look at their own background and what role they play in the supply chain. So you'll also see this kind of differentiation happening. All right, next, you can see that actually Plenty has been performing really well. And even in the midst of a downturn for the entire software sector, it still achieved good results, but its stock price kept dropping. This shows that at the moment, the capital momentum just isn't here. So for everyone, actually. Some people might be thinking about buying the dip, but actually, since the bottom hasn't been confirmed yet, we can still take a more cautious approach for now. If you buy in now, your funds could get stuck, and if more opportunities come up, you'll be in a tough spot to make the best use of them. So, so when it comes to the timing and level of entering an investment, everyone really needs to think it through more deeply. If the capital momentum isn't here anymore, it's better to avoid these kinds of stocks or groups for now. First, let's continue by looking at this table of semiconductor equipment stocks. You can see that their recent performance has been pretty good. They've been on a steady upward trend. So you can see that when it comes to an investment theme, it might be effective for a certain period of time. During that period, you should focus on the main theme. For example, previously it was memory chips, and now it's equipment. You don't have to keep searching for new themes all the time, because investing isn't about mixing everything together to get more returns. It just doesn't work that way. You need to do the right thing at the right time, and then you'll see results. Other approaches are relatively uncertain, and the growth isn't always linear. This is all about changes in market sentiment, and when it comes to capital and positions, everything can get anxious all at once. The way it plays out, it's not like you get a return that's directly proportional to the amount of effort you put in. All right, next up is TRTI, which is about sustained growth. So far, I haven't really seen any effective methods for that. As for what's coming up, actually, ER is also one of the stocks worth keeping an eye on this year. As for small, the company's performance is strong, and everyone knows it holds a monopoly position in its industry. So going forward, it's definitely something to watch. That's why we need to bring it up and talk about it, because it's closely related to this topic. In the aftermarket automotive sector, there's also a related company whose products hold a relatively exclusive position. So that's another one to keep an eye on going forward, and its stock performance has also been pretty steady. All right, next up is Broadcom. Right now, Broadcom is just consolidating, and it hasn't started trending yet. Their earnings report will be released in early March, so you might want to consider making some moves before Broadcom announces its earnings in early March. Besides doing a great job with ASICs, Broadcom is also involved in this area. They specialize in optical components and CPO technology for chip packaging, addressing thermal and transmission bottlenecks. They excel across multiple sectors. And it's also a leader in this field. So going forward, if you're looking to invest in a well-rounded tech company with strong fundamentals and good potential, Broadcom is definitely one to consider. Broadcom is also expected to maintain a leading position in ASICs and is projected to reach about 60% in this area. Though the ASIC market is volatile, Broadcom may hold a 60% share. Whether Google or Amazon develop their own ASICs, most will likely use Broadcom for production. This means that the shipment volume of ASICs should keep increasing, and by 2028, it might even surpass the shipment volume of GPUs. The deployment scale could exceed 40 million units, and this is mainly because of us. Because of the internal demand within autonomous driving centers, and also due to the architecture of large-scale computers moving forward. All right, so next I'll talk about 5 companies. First, as we mentioned, within the AI supply chain, we've seen many tech giants announce their capital expenditures, which are growing on a large scale. So let's discuss which companies are set to benefit from this massive wave of investment. Which companies are clearly positioned to benefit? At the same time, their stock prices might not have been widely discovered yet, or even if they have, their subsequent performance has still been pretty good. So what we want to do here is give everyone a direction. You can use these stocks as a starting point for further research, simulation, or to look for other similar targets in the market. You can use this to build your investment portfolio because, as we can see, when it comes to elections, whether it's about capital or seeking excess returns, more often than not, you'll find better opportunities in tech companies that have greater potential for growth. So that's the idea. In tomorrow's discussion, I'll introduce more non-AI related stocks, but today we'll still focus mainly on the AI supply chain because right now the AI supply chain is the key theme here is that these supply chain companies are clearly positioned to benefit from the AI boom. For now, when it comes to AI investments, we're steering clear of the big name AI companies like Google, Amazon, and Meta. These companies might face more pressure, so instead, we're looking for industrial companies where the benefits they receive are much more clear-cut. The first one is Ability. This has actually been talked about for a long time. It's the biggest company in power management at night. Even though, in terms of manufacturing processes, spending on manufacturing centers is about 20% at most, this company is still the leader. It's always the most clear-cut company, whether it's for GPUs or EPUs or different types of chips. You always need some kind of cooling solution, and this company can provide you with that solution. It's the leader in the physical format of AI data centers, and it has a whole series of completed solutions, of course, which you can use. Its moat is very strong. Many companies actually do similar things to what Beauty does, so they all end up doing what Beauty does. In terms of business, they can provide you with a complete solution. Company 12 has strong cash flow and its ability to secure orders is also very high. After it released its financial report, the stock price rose significantly. Even though the latest quarterly revenue might not have met expectations, that's mainly because last year's annual performance was so strong, and also because of its orders represent future revenue, so everyone says that you can maintain strong, sustained growth for a long time. So despite the issues, there's still a clear upward trend. That's the headline. So you can actually see that before this financial report was released, it really didn't perform much at all. But now everyone can see how well it's doing. Going forward, we actually already know that Vertex is a really solid company, and its situation of demand outstripping supply, or the demand for their orders will continue for several years into the future. So basically, everyone can wait for Verdi to pull back before making a move, or just keep an eye on it and look for a good entry opportunity. All right, next up is RS3 Network. This company mainly has a huge market in the area of switches. So about this RV3 network, so how does it benefit? If a data center is really large, as we all know, it definitely needs fast computing speed, but it also needs data exchange and connectivity. That's where Avestin can really make a difference. So for a company like this, According to the book, The Giants, companies like this benefit directly because not only do they have these large-scale switches, but they also have this USB-defined enterprise ecosystem, as well as the company's campus network. But this company has a very high gross margin, and its software is a powerful moat. It's not just a hardware company, it's a company that integrates both hardware and software. So, moving on. All the biggest tech giants have actually adopted this approach. They become more inclusive of the Ethernet architecture, which helps solve their switching issues. As a result, the company's performance, or rather its business performance, has been very stable and continues to grow steadily. But of course, as he said, I think its stock price actually isn't very well known. But considering that this company's long-term growth prospects are pretty good, its operations are very solid, and it's got a lot of momentum, the real question is how to take advantage of this opportunity. Actually, you can get involved because its stock price tends to pull back from time to time. So when it pulls back again, you can quietly buy in. You know very clearly that this company is definitely going to perform well, so you just gradually accumulate your position, and over time, you'll see a pretty good profit. As for L3, that's a relatively good way to get involved. That's great. I'm talking about Celestica, COS. So this company, well, right now, it's mainly in the business of assembling infrastructure, which is a relatively high margin sector. It's actually a long-established company that used to do electronic contract manufacturing, but it has shifted some of its business focus to higher margin areas like AI and defense. Its main involvement is in assembling more advanced network equipment, and it also provides software solutions. This company actually has a lot of growth potential, and its current valuation is relatively cheap. And as for its strengths, its main advantage is in addressing the practical challenges of AI capital expenditure, implementation, and manufacturing. If you're interested in this company, you can consider applying for an internship there. Well, at the moment, this company tends to be more conservative in its statements. Because of LE3, I feel like things are still being finalized. Even though it has released its financial reports and performed well, the stock price has just been moving sideways for a while. That's the current situation, but it hasn't gone down either, so it should probably sometime this year. Once everyone realizes how good it is, there will be a chance for it to perform. But for now, before this breakout starts, there will be a long period of consolidation. During this consolidation, it's also possible that it might dip, so everyone could set a target around the lower end of this range and then start buying in, gradually accumulating shares of CSTR. Later on, there should be a pretty decent increase in price. Next up is Marvel. Marvel is like a connector and also acid, and it can be used in many different areas. In the semiconductor ecosystem, it's really an all-around company. But its halo isn't as bright as, say, Broadcom. It's under more pressure because it's considered a second-tier manufacturer. So right now, its stock price is its performance isn't as impressive as Dynam's. So the idea here is that it mainly focuses on both computing and connectivity. Now, what's the difference between it and Broadcom? Well, Broadcom mainly deals with operations and logic control for switching and exchanging. But we have to emphasize that Marvel's really strong when it comes to transmission and especially in integrating communications. This is what allows Marvel to have a place in the AI ecosystem. It already has TDs and a certain level of irreplaceability because basically they can also make A-type products and they're really good at connectivity, so they can provide more of these comprehensive solutions for you. But right now, Marvel's approach is kind of similar to AMD's investment logic. They're not necessarily aiming to be the biggest in terms of price, but they do want to increase their real volume. And since their base is relatively low, if you can actually grow from a low starting point, then actually your growth rate will be very high. For example, if by 2028 their market share can increase to 20%, that's a 100-fold growth, 100 times bigger. Even though Broadcom might be able to maintain a 60% market share, Marvell's actual growth would be 100-fold. So in this kind of situation, the growth will be very rapid, and as a result, people might have a different perspective on its valuation. And in addition, Marvell has also received orders from Microsoft and Amazon. This part should gradually start to boost their revenue. At the same time, their profits will also improve. You can see that currently their performance hasn't been particularly outstanding. The stock has been trading sideways for the past 6 months, and after possibly forming a top, it's something everyone can keep an eye on going forward. Because what we're looking for here is a potential breakout over a period of time along with a wave of gains. So this could present an opportunity for everyone. As for the tech downturn, well, A-Lab, the architect is a Vista Lab. As for Exterior Labs architecture, its revenue is very straightforward. 100% comes from data centers, and its main focus is GPU interconnects, as well as this. Internally, there's the PCI upgrade cycle, and going forward, even though we all know that optical connections will eventually replace copper wires, and later on there will be CPOs, does that mean the current technology will become worthless? Actually, that's not the case. Because inside the server, for really short distances, you can still use copper cables since they're cheap. But for finished products, the cost is much higher, and you don't really need to use optical connections. So in the future, copper and optical will probably coexist. But the thing with copper is that signal attenuation happens quickly, so PCI or retimers are needed to reshape and adjust the signal, allowing it to transmit properly. During the process of signal transmission, it won't be affected by interference, distortion, or attenuation. That way, the transmission power and efficiency keep getting better and better. So the demand for maintaining signal integrity becomes even more critical, which means the need for proper adjustment will skyrocket. Looking ahead, this actually presents an opportunity for extra labs because they have a real advantage in short distance transmission. If you want a better transmission protocol and faster signal refresh rates, then you'll need even more of these signal tuning or calibration methods. As for optical solutions, they're mainly used for inter-rack connections or optical module clusters. So for short distances, for situations where the distance isn't that long, copper cables will still be the main choice. The company doesn't just focus on computers, it also has optical technology. For example, last year it acquired AIX Scale Photonics, and its main goal is to define standards for optoelectronic coupling. As for what comes next, they actually have a product called the Scorpio S series, which can connect optical switches to accelerators. So, in other words, it's something that can still be used within the realm of photonics. So it's not just that. They're not only focusing on copper wiring. In the future, when it comes to photonics, they'll still have room to make an impact. And what are they aiming to do? Basically the same thing they do with copper wiring, like signal packaging and protocol conversion. I can remotely check where there are issues, that sort of thing. So if they can clearly do a great job from the start and then move into photonics, and photonics also needs them, then this whole framework might be reevaluated. This is a follow-up opportunity. So what about the near term? Why did this company perform well in this financial report? As we just discussed, the good news has already been priced in. So right now it looks like a consolidation period. That's because its gross margin is being suppressed. You can see this with a lot of tech companies. Maybe their growth looks fast, but their gross margin gets squeezed. Their profit margin gets compressed, and then the stock price drops. But if these things can be improved in the long run, it will all work in their favor. That's a highlight. If your revenue keeps growing and your gross margin or profit margin also improves over time, then the stock price will keep going up. All right, so its gross margin for Q4 2025 was 75.78%. Now the remaining prices already dropped, and for its Q2 2026 gross margin, it's only around 70%. That's mainly because of a product mix with lower profit margins. For example, lowering its gross margin. Also, it needs to keep increasing its investment in R&D to respond to competition one-on-one. So right now, actually, this company's focus on R&D puts short-term pressure on it, but in the long run, it's a good thing. So even though the long-term outlook is better, the amount of spending might suppress cash flow and profit margins. That's why, at the moment, its stock price isn't performing particularly well. Going forward, there should be plenty of opportunities. Take XY Land, for example. It's also fluctuating within a range right now. So I suggest everyone consider buying at the lower end of the range and then either sell at the upper end or wait for a clear breakout. That way, everyone can see more obvious short-term gains from these swings. All right, that's all for today's equity update. Good night, and thank you all for watching.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.